Hi there, I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Adidas, one of the world's biggest sportswear brands, known for its three stripes, global presence and fierce rivalry with Nike. After a few turbulent years, management is focused on stabilizing growth and strengthening the balance sheet. We are going to break down Adidas using our 5 key factors to determine whether it's undervalued, fairly valued or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. Great businesses start with efficiency. If a company can't earn strong returns, nothing else matters. Looking first at return on invested capital. Adidas comes in at 8.4%, well below peers. Nike is at 29%, Lululemon at 40.4% and Under Armour is at 6.6%. Next up, return on equity. Adidas posts 14.2% compared to Nike at 40.1%. Lululemon at 42.4% and Under Armour at 11.3%. These returns show Adidas is significantly less efficient than Nike or Lululemon, but slightly better than Under Armour. Over the past decade, Adidas' growth has been underwhelming. Revenues grew at a compounded annual growth rate of 3.3%. Net income grew at a CAGR of 1.6% and earnings per share grew at a CAGR of 2.9%. This weak track record is not just about the Yeezy revenue loss. The trend has been structural, showing Adidas has struggled to generate sustained growth. Earnings per share was slightly higher than net income historically, thanks to share buybacks. But with buybacks suspended in 2023 and 2024, earnings per share growth now mirrors net income. This weak historical growth suggests Adidas may struggle to justify premium valuations. Now let's see whether management has made any progress in strengthening the balance sheet. Cash and short-term investments sit at 2.6 billion euros with total debt at 5.8 billion euros. This gives us a net debt position of 3.2 billion euros. Debt to equity is at 1 today, up from 0.3 in 2015. While this is higher than in the past, it has stabilized over the last 2 years as Adidas has reduced debt. Now looking at free cash flow coverage, Adidas generated 2.6 billion euros in free cash flow versus 5.8 billion euros in debt, which is very healthy coverage. Overall, Adidas' balance sheet looks sound. Leverage is manageable and not a near-term concern. Even the best companies can be poor investments when investors overpay. So how is Adidas valued today? Adidas trades at a price-to-earnings ratio of 28.2. Looking at peers, Lululemon trades at 11.9, Under Armour at 22.3 and Nike at 36.9. So Adidas is valued closer to Nike than to Lululemon, but its returns and growth are far weaker. Now let's adjust the PE for growth using the PEG ratio. Analysts expect long-term earnings per share to grow at 39.7%. This gives us a PEG ratio of roughly 0.7. This PEG ratio looks cheap, but it's misleading. Given Adidas' historic single-digit growth, it's hard to believe such a bullish forecast will play out. Even CEO Bjorn Gulden admitted raising guidance wasn't prudent despite a strong start to 2025. In reality, the PEG ratio flatters Adidas. When adjusted for its structural weaknesses, the stock looks expensive, not cheap. Does Adidas have a moat strong enough to justify that premium? The strengths of Adidas is that it's an iconic global brand with strong heritage and a diversified production network. But there are risks. Looking first at tariffs. For US imports, Adidas is heavily exposed. 30% of supply comes from Vietnam, where tariffs are up 20%, and 23% of supply comes from Indonesia, where tariffs are up 19%. This directly pressures margins and could force price increases or lower profitability. Next up, competition. Nike dominates in scale and innovation. Lululemon is winning in the premium niche. And finally, execution. Adidas' reliance on hype cycles like Yeezy, leaves it exposed when trends fade. Adidas has a moat, but it's narrower and more fragile than Nike. And in my view, not strong enough to justify today's premium valuation. Now before we wrap up, the detailed financial charts in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link below for 15% off to level up your stock research at no extra cost to you. In my view, Adidas stock is overvalued based on our 5 key factors. Weak return on invested capital and return on equity show inefficiency compared to peers. Long-term growth has been structurally weak, not just a Yeezy issue. The balance sheet is sound with healthy free cash flow coverage, so leverage is manageable. Adidas stock is trading at a PE ratio of 28.2 and an optimistic PEG ratio of 0.7. Adidas is priced for a growth story it hasn't delivered in the past. Adidas is a recognizable brand, but tariffs, competition and execution risk limit durability. Adidas trades at a premium price for subpar performance. Until management proves it can deliver sustainable growth, I see it as overvalued. What's your take on Adidas? Drop a comment, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.